Greetings. This is Axel, the President and Chief Investment Officer of Merk Investments, with the latest US business cycle chart book. As always, these charts are prepared by Nick. I give the in-between-the-line comments on them, and feel free to download the chart book at merkinvestments.com/research, and the blue text underneath is Nick's analysis. I will focus on some added interpretation. The business cycle is important because during economic expansions, the equity markets, amongst others, tend to do better. Most bear markets in the past have been during economic downturns, economic recessions. There are some notable exceptions, notably the '87 crash. And clearly in the context of what's happening right now, we have seen some hiccups in the markets. And the obvious question is, well, is that the end of the bull market or not? We look at several different chart sets. This one is the business cycle. We have another one, the S&P. We have another one on interest rates and the Federal Reserve. And then after this one, we will soon be publishing one on the Federal Reserve specifically because the Fed is meeting. And by the way, as you're listening to this, is almost certainly after the midterm election. We are recording this before the midterm election. So just put that into context, and pardon me if I am ignorant of anything that is about to happen. Leading economic indicators look dandy, and the chart here says it all. The yield curve steepness, as a reminder, the relationship between the short-term and the long-term end of the yield curve. And many people argue that recessions may be imminent as shorter-term rates go above longer-term rates. Here in this example, it's the 10-year yield versus the 3-year yield. That's been picking up of late, and that can happen because not only are short-term rates going up, which would suggest at some point the yield curve will invert, but if the long-term rates also rise, then it is, of course, possible for that yield curve steepness to increase. That reduction in the steepness has been happening for years. Now, the reason it gets the attention now is because we might get this inversion of the yield curve, meaning short-term rates are higher than long-term rates. Note here in the 60s, for example, there's been a false signal. Also, it doesn't always mean that a recession is imminent. You see that in the 80s as well. And also note, and I've mentioned this many times on these recordings and otherwise, it is not the Fed's mandate to prevent the yield curve inversion, even if some at the Fed might imply it is. They have plenty of other mandates. The reason the Federal Reserve historically has tended to hike, although the yield curve has inverted, is because there are other reasons why they very well should. And that is usually because inflationary pressures are building. And this particular chart doesn't have too many things on inflationary pressures, but just keep in mind, we do have an economic stimulus. We have record low unemployment, and we have a monetary stimulus still. That's according to the Fed, and I tend to agree with that, even as rates have gone up. We're still taking the foot off the accelerator. We're not slamming on the brakes. And so at some point, they might have to push the brakes. And that is why very often in the past, economic expansions in our analysis have come to an end, because the Federal Reserve has hiked into a slowing economy. And there's a reason for it. Is the Fed is backwards looking, almost by definition, because they are quote unquote data dependent. Powell actually is fairly transparent on what data he is looking at, but by being data dependent, he is looking in the rearview mirror, and that means something might be happening in the economy. There are others. Greenspan, he was one who put out his neck and forecasted certain things would happen and would conduct monetary policy accordingly. Powell is not of that breed, in my view. He is somebody who will react, which also means he'll continue to hike with the background noises provided by our tweeter-in-chief, meaning odds are pretty high, in my view, that we will be hiking, or the Fed will be hiking into a slowing economy, and that's going to get the ire of various constituencies, including that of the White House. PMI, the Purchasing Manager Indices, there are, by the way, two different series. We tend to look on the ISM ones. That's for data nerds. You can look into that in more detail. We happen to think that's the better series for the US. In the rest of the world, we look at the market series that you look at in the second as well, but for the US, we look at this series. And here it shows that, yes, the economy does well. Now, that said, as you might have heard, in the rest of the world, not everything looks so dandy. If you look, I don't know whether you can see the mouse, the German line here has been sliding downward this year. 50 is considered economic expansion, and last time I believe I discussed similar reasons why it might be coming down. Some of it could be short-term data due to new environmental emissions control standards in the automotive industry that prevented the automotive industry to actually get cars sold because they didn't have the testing equipment. But there are other drivers, notably jealous about trade, that might prevent investments and other things. Important to watch might be China. The Chinese are still above 50. It's above 50.2. That's here on the black background. And if that were to dip below 50, you can be assured of some headlines. Not that somebody's going to flip a switch that suddenly there's going to be a recession in China, but obviously the Chinese are sensitive to that. So internationally, we've seen a mixed picture. The question is, can the global momentum be preserved? Because even though the momentum is slowing, above 50 still means expansion. And clearly we have seen various tensions in emerging markets on both the currency side and also some markets having more difficult access to credit. But in the U.S., to go back here to the U.S., the unemployment rate continues to tick down, so that one looks great. Now, of course, the flip side of that is, are we exhausting the pool of available labor? And the reason why that may be a concern is that if there are no people left to join the workforce anymore, well, then you're going to get inflation. And while that may be great for somebody to earn a little bit more money, that does signal to the Federal Reserve that maybe we have to hike rates a little bit so that we're not going to get too much inflation. Here, the Congressional Budget Office publishes its own metric on where capacity utilization is, and this suggests we're above capacity. Now, note, these are estimates, and the historic graph shows you that there is some validity to it. It doesn't tell you exactly when the economy is going to come to an end. A similar metric here on the quote-unquote output gap. They're good to cross-check. I don't consider those the best in the predictive power. With hindsight, yep, we can read things into that. Here's an interesting one. The Atlanta Fed is trying to forecast on a real-time basis where GDP is going to be, and has a reasonably good track record with that. Economic expansion, obviously, from that one also expected to continue. A very important one, the credit cycle, delinquencies. And a lot is being said about debt levels. Now, absolute debt levels are at very high levels, but households, according to this metric here, which is a pretty important one, I believe, seem to be doing just fine. That's very relevant. The other relevant part is that, I don't think we showed them here, there's a lot of being said about housing markets slowing down, and because affordability, of course, being impacted by higher rates, the housing sector is about half as relevant to the U.S. economy as it was in 2007. And that doesn't mean higher mortgage rates don't have an impact on the markets anymore. And there's, of course, a follow-up impact on stuff you may buy at Home Depot and whatnot. But still, the consumer is doing just fine. And indeed, if anything, there's a contrarian signal here that the consumer might be overconfident. Everything is great. And so this is a bit of a cautionary sign that when you go that high, well, is it going to get much better? And that's, of course, part of the thing about the stock market, that it's been showing signs that, well, maybe it's not going to get much better. Many of you have heard about earnings, peak earnings. Well, earnings are expected to continue to rise, but the rate at which earnings will rise is going to slow down. And that's just because you have this tax cut, so you got this immediate boost, and then, of course, from there, it's difficult to continue to climb. And so it depends on whether you're glass half full or half empty type of guy or gal. Odds are, obviously, that earnings are going to continue to high, but maybe with higher rates, we're going to get some multiple contraction on the price to earnings ratio, and maybe that warrants a little lower prices. But at the same time, hey, we're getting a new Congress. Maybe they actually get something done. Who knows? Maybe something's going to happen on trade and whatnot. So this here, again, just as the Fed is looking backwards because we're looking at these metrics, consumer confidence might show you a little bit of whether people are willing to spend money. Ultimately, it depends on what type of investor one is, at what time you want to take chips off the table. And for many people, taking chips off the table only requires to rebalance because the equity portion of one's portfolio has gone up quite substantially. And this is a reminder to many investors that they might want to do it. Lending standards, very important metric for the business cycle. The point of rate hikes, and apologies for being repetitive, I've said this in the past as well. The point of Fed rate hikes is to tighten financial conditions, to make it more difficult to access credit. That's the whole point of hiking rates. You want to hike rates, you want to make it more difficult so that we don't get too much inflation. And the best thing some people have said that could happen to the economy is to become dull now, right? We are at this very low employment level, so let's just keep it at that pace. If we keep adding huge number of workers every month, we will just, by the numbers game, run out of workers to hire, and we're going to get too much inflation, which means the Fed has to slam the brakes. Here, we've seen, let me show you this one here on the high yield spreads, that has ticked up. And so this little turmoil we had in October in the market has gotten the high yield spreads to widen a little bit. High yield spreads, these are junk bonds, how they trade versus treasuries, and that has ticked up. But as you can see, by no means has that spiked dramatically. And as long as we don't see a substantial spike, the Fed is going to continue to hike. And if that were to spike, then we can see a Powell Fed saying, all right, let's see and wait what's going to happen. But they'll continue to hike and maybe until that thing goes higher. Now, as you can also see, that thing has gone higher, and it doesn't mean we immediately have a recession. As Nick, I believe, points out down here, that once we've had a yield curve inversion, quite often we see a bit of a jump. So that's just something to keep in mind as well. Building permits, doing all right, but maybe late cycle indicator, clearly the mortgage rates have gone up. And so Nick puts this together here in this framework. Again, you can download the PDF to look at more offline, and feel free to also download the PDF to read the specifics here. From my point of view, if you just look at the business cycle continues to do fine. We're clearly at late stages of the economic expansion, but that doesn't mean it's going to fall into recession tomorrow. Indeed, there is no sign that that will happen. It can go on for another 6 months. It can go on for another 9 months, 12 months, 18 months, even longer potentially. My baseline scenario is that the Fed will continue to tighten, as at some point we will show these signs of tighter credit conditions. In the meantime, the higher rates are associated with more volatility. And just academically, the reason that's the case is because higher rates warrant a greater discounting of future cash flows. And therefore, quote unquote, suddenly, you're going to have more volatility, because as your projection changes going forward, the more shorter term outlook becomes more relevant, because the further out outlook becomes more discounted. Now, that might be a very academic way of explaining it, but it does suggest to me that yes, we will get higher rates, and it does mean that we'll get higher rates, by the way, than are priced into the market right now. We're pricing in fewer than 2 rate hikes next year. We'll almost one, or probably 1 rate hike still this year. To me, that's not going to be enough to tame inflationary pressures, as we're going to continue to continue on the economic expansion. Now, some people may say, hey, what about this new Congress? And again, I'm recording this before the election. Even if we have, or if we have, I wouldn't even say even, if we have gridlock in Congress, it's difficult to get anything done in Congress. On the regulatory side, there is still room you can move on and provide fiscal stimulus, if that's what one wants to do. Just as in the Obama administration, Obama did not have the majority and was able to get certain things done. And of course, one of the big unknowns is what's going to happen with trade. There are signs that there might be some things being resolved. This can, of course, take many different turns, but that's all speculations, all crystal ball. If one just looks at the business cycle, that one is firmly intact. What does it mean translated to one's portfolio? Well, as we've seen in the increased volatility, that is something that may well be associated with this phase, right? And so it really depends on what sort of investor you are, whether you're comfortable with that. Based on our analysis, that volatility is going to continue if anything, that's going to increase. And so if you have a model that you have a certain risk tolerance, well, then it may be time to de-risk your portfolio a bit. Doesn't mean you have to hunker down and run for the hills, but one has to be aware that this environment has been changing. You're not the only one who does that. I've argued many times that many people haven't rebalanced the portfolio. Just to show the other side of that, I read an institutional report that argued that that many institutional investors have moved in that direction to de-risk. And so take that as it may be. I happen to think that this de-risking is a process. It doesn't happen overnight. And so more and more people will gradually do it. And now, of course, as that happens, the question is what to do with one's investments and where to invest and so forth. Cash may not be a bad alternative. And obviously, I can't give specific investment recommendations here on this video, and that's not my role here. I would like to point out that we have started to offer some ability to provide services on this, on how to invest, where to invest, and so forth. If you're interested in that, then please go to merkinvestments.com/wealth, or just go to the homepage and you'll see a button where you can click on the family office button where you may find more information. All that said, hope you enjoyed this. Please give us some feedback. Make sure you go to merkinvestments.com/research to look at the remaining resources. Also, please look at the premium chart book that is available, where Nick goes into more depth on some additional charts. Thank you and have a great day.